Okay, great. Thank you, Helene. Now we're going to discuss legging into debit spreads, and we do both the simultaneous entry that Helene just discussed, and we also like to leg into debit spreads from existing call option purchases that are profitable. So we trade both the simultaneous entry into the debit spread, and we will also purchase a call option using our ETF trade selection process. And then if that call option is profitable, then at a later date, we'll leg into a debit spread to protect those profits. So that we'd like to trade both strategies, the simultaneous entry and also legging in at a later date if you have a profit. And that gives us further diversification in our trading strategies. So let's just quickly review the ETF option purchase strategy. And we would use this, of course, to purchase an ETF directional option trade. And the first rule is we want to purchase an ETF call option using the ETF trade selection process to select a high probability trade. And after purchasing a call option, we use our trade management principles. We went over these in last month's webinar, and we use those trade management principles to manage the option purchase. And they basically are, we exit losing trades quickly, and we don't exit winning trades with a small profit. So if we're going to take a directional trade, we use the ETF trade selection process with a high relative strength and a retracement to the middle or lower Keltner channel. So once we take that directional trade, then we use money management principles to manage that directional trade. And we'll exit losing trades quickly. We'll usually exit an option purchase trade before it turns into a 20% loss, and then just move on to the next opportunity. And then we don't want to exit winning trades with a small profit, as that's not good portfolio management. You want to hold on to those winning trades because that's where you're really going to make your money. And then if we, one of our money management rules is if we have a 30% or greater profit in the call option purchase, then we want to sell to open a call option with a higher strike price at a later date to establish a debit spread. And this is known as legging into a debit spread. So when you leg into a debit spread, it starts out as an option purchase. Once we purchase the option, we use our money management guidelines to manage that trade. And then if we have a 30% profit or greater, then we'll leg into a debit spread at a later date. Now, when you sell to open a call option, your trading account instantly receives a cash credit for the option premium that you sold. So if you sell a call option with 4 points of premium, then $400 cash is credited to your brokerage account. So if you purchase a call option and then the option increases in value, the sale of a call option at a later date generates a cash payment, and that cash payment will increase the profit potential of the existing call option purchase by as much as 100%. And I'll show you some examples of that here in a minute. And that cash you received into your account also provides downside protection in the event the underlying ETF decreases in price. And selling the call option also reduces the cost of the option purchase, so that reduces your dollars at risk. And when you have a bullish debit spread, of course, the call option that you purchased, that profits if the price of the ETF increases, and the call option sold will profit if the price of the ETF decreases. And your risk is limited to the cost of the spread. Let's look at a few leg-in trade examples. The first example is for the utility ETF symbol XLU. It was on a buy signal using our ETF option trade selection strategy, which is the high relative strength, the retracement to the middle or lower channel, and then we used the 1% rule to select the strike price. So we used our trade selection strategy. We purchased the XLU 42 strike call at 474. So this is our a snapshot of our brokerage confirmation, and we purchased the XLU September 42 strike call at 474. So we had, once we purchased this option, we used our money management principles. We developed a profit in this trade, so we had a 30% profit. So then we legged into a debit spread. And our brokerage confirmation shows that we sold to open the XLU 48 strike call at 190. So this created an option debit spread. We legged into the spread, and at the time XLU was trading at 50.32. So we already owned the 42 strike call, had a profit in it, so at a later date we sold the 48 strike call at 190. So again, bought to open the 42 strike call at 474, sold to open the XLU 48 strike call at 190. So this created a net debit in our account of $284. So the cost of the spread was $284. Now, when we purchased the 42 strike call, we had $474 at risk. Of course, when we sold the 48 strike call, we reduced that dollar risk from $474 to $284. So we reduced our risk at the same time. XLU was trading at 50.32 when this trade was initiated. We bought the 42 call and sold the 48 call, so this was an in-the-money spread. And as Elaine mentioned, the in-the-money spreads give us more downside protection and a higher probability that the trade is going to be profitable. In-the-money spreads can profit if the underlying stock or ETF is down at option expiration, which gives us a huge advantage over a directional trade. Let's look at the profit potential for this XLU debit spread. If XLU is up at all or is flat at 50.32 at option expiration, the spread will realize a 111% return before commission. And if XLU is down 7.5% at 46.55 at option expiration, then we'd realize a 60% return before commission. Now, selling the 48 strike call for 190 points resulted in a 150% increase in the profit potential of the 42 strike purchase. So that gives you a big advantage. The profit potential of the 42 strike call that we bought was increased by 150% by selling the 48 strike call for 190 points. So this is another big advantage of debit spreads. And of course, the sale of the 48 strike call also provides downside protection in the event the XLU ETF declines in price, because you're short a call and that will profit as the underlying ETF goes down in price. So to recap, if XLU is up at option expiration, we will realize 111% return. If XLU is flat at option expiration, we'll realize 111% return. And if it's down 7.5%, we'll realize a 60.1% return at option expiration. So profiting when your ETF is flat or down gives us a much higher probability of success as traders. Let's look at one more example quickly. This is for the NASDAQ ETF symbol QQQ, and at the time it was on a buy signal using our ETF option trade selection strategy. You can see from our brokerage account statement, we bought the September 100 strike call at 779. We had a profit in this trade, so we legged into a debit spread at a later date, and our brokerage confirmation shows that we sold the QQQ September 109 strike call at 440, and this of course created an option debit spread, and at the time QQQ was trading at 110.68. So bought to open the 100 strike call at 779, sold to open the 109 strike call at 440. That produced a net debit of $339. So the cost of the spread was $339, and selling the 109 strike call at 440 reduced our total dollar risk on the trade, the call option purchase trade, from 779 to 339. And we bought the 100 call, sold the 109 call, so this was an in-the-money spread. And of course, as we mentioned previously, these in-the-money spreads give us more downside protection and a higher probability that the trade will be profitable, and they can profit even if the underlying stock is or ETF is down at option expiration. So we can see if the QQQ was flat or up at all at option expiration, we'd have a 165% return. If it's down 5%, we would have a 51.8% return. Now, selling the 109 strike call for 440 resulted in a 200% increase in the existing profit potential of the 100 strike purchase. So again, when we sell option premium, cash is credited to our brokerage account, and in this example, it increased the profit potential of the existing call purchase, the 100 strike call purchase, by 200%. And of course, the sale of the 100 strike call also provides downside protection, as that short call will profit if the ETF goes down in price. Okay, so let's just review the advantages of legging into a debit spread. Number one, we have an increased profit potential. So the sale of the call option when you leg in at a later date can increase the profit potential of the existing option purchase by 50 to 100% or more. In the example of XLU, the sale of the 48 strike call increased the profit potential of the existing 42 strike call by 151%. So that's one advantage of these spreads. The second advantage is, of course, they provide downside protection. The sale of the call option results in cash being credited to your brokerage account, and that reduces the cost basis of your option purchase. And the short call profits if the underlying ETF goes down in price. So it provides downside protection as soon as you sell that call option. And the third advantage is it can reduce your dollar risk, and we saw in the example of XLU, it decreased our dollar risk from $474 to $284, and it reduced the risk on the QQQ spread from $779 to $339. And the last advantage of these debit spreads is that they can be profitable if a stock or ETF goes up or down. So we saw the examples where the ETF was down as much as 10% and we still profited on the trade. So these spreads can be profitable if the underlying ETF is up, down, or flat. Okay, we have an option trading service, and we make trade recommendations for debit spreads. And with our trading service, email alerts are sent out to the members with specific instructions whenever there's a new option trade recommendation or an existing trade is closed out. We maintain several portfolios of option trade strategies, and the prices are updated real time so the members can track the profit performance of every trade recommendation we do, including the debit spreads. And we also maintain a closed out trade record of all closed trades so that we have a full accounting of all the trade recommendations that were made in the trading service. And we also make available the 6 option calculators for the different optioneering strategies. We make those available to members of our trading service. I took a snapshot yesterday of our open trade profits in our ETF debit spread portfolio. This column here lists the current ETF debit spreads that we have on. We list the entry price, the number of contracts, the last price, and then the profit and percent return. And as of yesterday, we had $303,000 in open trade profits, average return of 351%. So as you can see, the ETF debit spreads are performing very well this year, despite the volatile market conditions. And if you're interested in becoming a member of the trading service, the Inner Circle Trading Service, you can call 866-661-5664. And you can also log on to chuckhughesic.com and click the trade results link, and it will show you updated profit performance for these various strategies that we trade in the Inner Circle. We have a stock strategy, dividend strategy, option strategy, option debit spreads, married puts, buy rights, and a microcap profit alert. So if you click trade results, it will give you updated profit results for these various strategies, Hughes Optioneering strategies. So